You find a perfect support level. You place your trade, you watch the price drop right to your line, and then break right through it, stopping you out just before it reverses and runs to your target without you. Or maybe you try the opposite approach. You wait for a momentum indicator to flash a buy signal, you jump in, and the price immediately stalls and collapses. We can eliminate both of these failure points using a mechanical execution system called the Sniper Convergence. This schematic breaks down how it works. On one side, we use the DRW Quant Levels to find our exact location. On the other side, we use the True C Liquidity Matrix to time the entry. By combining a higher timeframe demand zone with lower timeframe momentum, you execute based on actual institutional order flow, removing retail guesswork from your setup. Step 1 is mapping our location. Open a clean chart and set it to a macro timeframe, specifically 15-minute or 20-minute intervals. Using DRW Quant Levels, we identify a bullish order block. This translucent teal boundary highlights candles where major buying originated. To gain extreme accuracy, we draw a horizontal yellow line straight through the exact center of this block. This central axis is called the 50% Equilibrium Midline. This midline is a magnetic zone for price pullbacks. It marks the highest density of institutional limit buy orders left behind from the initial move. Mapping this higher timeframe midline gives you a definitive where for your trade. You are no longer guessing where support might be in empty chart space. With our location mapped, we need our engine. To time the execution, drop your chart down to a 3-minute time frame. As this zoomed-in chart shows, we are watching the price drop aggressively downward, heading directly into that yellow 50% equilibrium midline we mapped earlier. Warning tone. Do not press the buy button the moment the price touches this line. That is a common and costly error. Instead, we use the True C Liquidity Matrix. This execution engine is required to prove that institutional money is actively absorbing the retail selling pressure. Without micro-level proof of absorption right at our macro-level location, any support line is likely to break. We need confirmation before risking capital. The True C Matrix requires 3 simultaneous events: a micro-momentum reversal, a surge in institutional volume over the baseline, and a large expansion candle. When all 3 hit, we get an electric lime TC label. This specific True C signal fired directly on top of our 15-minute midline. When stacked perfectly like this, they create what is called nested alignment. A standard True C signal in random chart space is useful, but it lacks the backing of higher timeframe demand. A fully aligned, nested signal provides both location and momentum. Nested alignment pinpoints the exact millisecond the macro tide and micro momentum converge, putting the math heavily in your favor. With our signal confirmed, we move to a strict mechanical execution process. Our entry is executed precisely at the close of the purple star candle. Place your stop loss strictly below the absolute low of the sweep wick. Finally, align take-profit exits with the prior regular trading hours high or the nearest liquidity pool. Following these placement rules guarantees an asymmetrical risk-to-reward ratio. Your entry is anchored to the exact origin point of institutional momentum, keeping your downside small and your upside large. Here is the completed, fully mapped trade setup. Compared to a chart covered in lagging indicators, this view is clean and clutter-free. We mapped our location, we waited for our timing trigger, and executed a high-probability trade. Stop entering positions in unmapped territory. If you don't have institutional demand backing your level, you are trading in a void. Load your indicators, map out your first 15-minute midline, and start patiently trading the convergence.